Financial statement analysis project, we chose the Delta Airlines Company, presented by Brenna, Briajah, and Lauren. My name is Lauren Gabel, and I'm going to discuss the first couple of slides. First, we're going to talk about our key takeaways. We're going to introduce the Delta Airlines Company, present their financial ratios, and discuss how they've changed over time, and compare those financial ratios to the air travel industry. And then at the end, we're going to discuss what we've learned from doing this project. The 5 financial ratios that we're going to discuss include liquidity, efficiency, leverage, profitability, and market value ratios. So now a little bit about Delta Airlines. They are one of the major airlines in the United States and legacy carrier. Their headquarters are in Atlanta, Georgia. Fun fact, they're the oldest operating airline in the United States. Delta operates flights to 242 destinations in the 52 countries across 6 continents. Delta can also operate over 5,400 flights a day. One of their goals is that they strive to ensure that the future of travel is connected, personalized, and enjoyable. Now we're going to look at the 5 different sets of ratios and how they compare to the air travel industry. First, we're going to discuss liquidity ratios. The liquidity ratio helps determine the company's ability to pay short-term debt obligations without raising external capital. The liquidity ratios indicate financial health and the ease of converting cash assets into cash. They also help investors, creditors, and financial analysis assess the company's financial stability. The 3 ratios that we're going to look at on the next slide include current ratio, quick ratio, and cash ratio. So the first graph, current ratio analyzes the company's ability to pay its current liabilities with the company's current assets. So by looking at the graph, you can tell that it's pretty consistent throughout the 3 years when we talk about Delta Airlines. It shows that the company has way more liabilities than there is assets. For our industry comparison, by also looking at the graph, you can tell that it has a higher current ratio, and overall, the industry is able to pay most of its current liabilities with current assets. So overall, you can see that Delta Airline is below the industry average. The next graph is the quick ratio, which this ratio analyzes the ability to meet or pay the company's short-term obligations with their liquid assets. And those liquid assets include cash and accounts receivable. As you can tell in the graph, it is pretty consistent in 2024 and 2023 when we're talking about Delta Airlines, but 2022 stands out because it's 3 times higher than the years prior. And I think this could be due to inventory that they've had on stock. Overall, this graph shows the company, again, is not able to meet its short-term obligation to pay their debt with their current assets. For the industry comparison, the industry again has a higher ratio, but Delta is not too far off. This shows that the industry is pretty comparable when it comes to analyzing the most liquid assets. And our last graph, we're going to talk about our cash ratio. Cash ratio measures the company's ability to pay off any current liabilities by strictly using only cash. Again, by looking at the graph, you can see that Delta Airlines is pretty consistent over the 3 years. This analyzes that our company is not able to pay off many current liabilities by strictly just paying it off with cash. For our industry comparison, the company is way under average. This shows that the other airline companies outnumber Delta in their ability to pay off any current liabilities with cash. Now I'm going to turn it over to Briajah, who will be discussing the efficiency and leverage ratios.
Hello, I'm Briajah, and I will be taking over the next few slides. So what we have is efficiency ratios that analyze how well a company uses its assets and liabilities internally. It measures how well a company utilizes its resources. So for the first one, asset turnover, a higher asset turnover ratio indicates that the company is utilizing its assets more efficiently to produce revenue. It can change over time by business growth. Inventory turnover If it's higher, it indicates efficient inventory management, meaning the company is selling goods quickly and doesn't have excessive stock. A lower ratio suggests overstocking or slower sales. It can change over time by sales fluctuation. Days sales inventory helps asset inventory management and indicates how quickly a company can convert its inventory into sales. It changes over time by sales fluctuation as well. Days sales outstanding provides insight into the efficiency of a company's account receivable management and cash flow. It can change over time by customers' payment behavior or changes in sale volume. So for the graph, asset turnover ratio went up over the years, but is still significantly lower than the industry ratio. Inventory ratio went up 2022 to 2023, then dropped a little in 2024. Industry ratio in 2022 is significantly lower than Delta Airlines in 2022. Days outstanding ratio has gone down over the years from Delta Airlines. 2022 Delta Airlines is still higher than the industry average. Day sales and inventory ratio has gone down a bit and in the years 2023 to 2024 compared to the year 2022. The industry ratio in 2022 is lower than the Delta Airline ratio in 2022. Next, we have leverage ratios, which is debt to assets, debt to equity, and interest coverage ratio. So debt to asset, higher ratios indicate that a longer portion of the company assets is financed by debt when could imply higher, which could imply, which could imply higher financial risk. It can change over time by economic conditions or debt repayment. Debt to equity ratio is a financial metric used to measure a company's financial leverage. It's an important indicator of the financial health and stability of business. It changes over time by company growth and expansion, also profits and retains earnings. Interest cover ratio is a financial metric used to determine how easily a company can pay interest on its outstanding debt. It can change over time by change in earnings and interest rate fluctuations. For our graphs, the interest cover ratio in 2023 to 2024 is significantly higher than the year of 2022. The industry interest coverage ratio is lower than the Delta Airlines in 2022. The debt to asset in 2022 to 2024 has gone slightly down over the years. In 2022, the industry ratio is significantly higher than Delta Airlines in 2022. The debt to equity ratio in 2022 to 2024 has went down significantly over the years. In 2022, the industry is lower than the Delta Airlines in 2022. I'm going to now turn it over to Brenna.
Hi, I'm Brenna Elmlinger, and I'm going to talk you through the next few slides. Starting with profitability ratios, these are the measurements of how well a company generates money using a few different ratios. They have two different groups, margin ratios and the return ratios. For example, if you wanted to find out how much money a company keeps after expenses are taken out, you'd use the profit margin formula, which would be net income divided by sales. So starting off with these graphs, the top right, which would be the profitability ratios graph. That's what I'm going to talk about first. Starting with 2022, it would be your orange bar. Delta had a small return with a minimum profit, about 2%, with a spike up to 5%. 2023 purple column would be Delta had a higher profit this year compared to the last year. They have around 7.9% and 11% profit. 2024 is the light blue column. Delta had a minimum profit around 5% and a maximum of 8.7%. Comparing 2022 to the industry comparison, Delta had a higher performance when it came to net profit margin and operating expense margin, but when it came to gross profit, they were largely outperformed by the other companies in their air transportation industry. Speaking on return of assets, Delta had a return of profit from their assets that was very low in 2022. They had a slight increase, a large increase, my bad, in 2023 and 2024, a little bit of a decrease. Compared to the industry, they had a higher profit return of 1.82% to the industry of 0.003%. Return on equity, Delta was able to make its shareholders happy. They had a 20% return in 2022, which was doubled in 2023, and then a small drop back to 22% in 2024. The next slide will be market value ratios. These are financial comparisons to the company's stock price to its performance using these ratios. Earnings per share, price to earnings, and market to book. Looking at these graphs, earnings per share, the price of Delta's share started out at 2.58, which had a strong growth to an average of 7.071 in 2023, but then a slight decline to 5.372 in 2024. They had a strong growth year in 2023 compared to the other years when it comes to their price of stock. Their price to earnings, they had a 15.94 average in 2022, then a drastic decline to 5.628 in 2023, and then a slight increase to 11.260 in 2024. This would indicate that investors saw the value of stock more in 2023 compared to the other years. The market to book graph, with a strong average of 3.193 in 2022, they had 2.33 in 2023, with a tiny increase to 2024. This graph shows that the stock was valued more in 2022 compared to the other years that declined. Our conclusion that we have come to find is that learning the importance of financial ratios and how to properly compare them to a specific industry, as well as calculate these ratios and be able to visually compare them year to year. And then finally, we had our references here.